everybody understands, oh yeah, I trust the S&P 500. Yeah, I understand how index funds work. Yeah, I understand all of that. I know how to invest and make money long term.
How do you do it?
Yeah. And then it starts dipping.
Yeah.
And then you see their skin in the game, their actual dollars leaving their bank account. Ma! You were buying so hard at the top. And you're supposed to increase your size as it goes down.
Yeah.
But how come no money's going in? And you're supposed to sacrifice in your personal life, cut back on bills, get more in at the bottom.
Yeah.
And no one does that.
3, 2, 1.
All right, before you listen to this one, you need to go back because the last episode is on the S&P 500 and today's topic is going to be what it takes to beat the S&P 500. When we're talking about this, there's 3 levels of complexity that we can talk about today.
All right, so first of all, I think right now, like if we just think about what's been happening in the, macroeconomic environment, we've been in a massive bull market for like 12 years, from like 2010 to 2022. The market's gone up. So I think that's created like a lot of fake success where people are like, they feel like it's so easy to beat the S&P 500. Because during that time, it actually was decently easy to beat the S&P 500, especially if you're looking at your results prior to this year, before the market started to dip. So everybody they used to think it's like so easy to beat the S&P 500. But then when the market does get tough like it is now, then, there's that saying where when the tide goes out, you see who's wearing bathers and who's completely naked.
Yeah.
So that's one.
What does that mean though? Like, because we hear that a lot. Warren Buffett says that a lot. Like, what does that actually mean?
Yeah, it's just like you will see who is actually fooled by the bull market. The trend's just at their back and you can just get lucky the whole entire time. Like pretty much everything is going up because a lot of what affects the stock market is supply versus demand. When it's really easy to make money in the stock market, more money flows into the stock market, which makes the price go up again. And then if the price goes up again, people put more money in, they get so much confidence. So much money is flooding into the system. And if we think about what happened after COVID, there was that much money that flooded into the system. And it was all the Cathie Wood stocks, all the cryptos.
Money was so cheap.
Yeah.
You could just borrow money without having to pay it back with that much interest.
Yeah.
Stimulus checks.
Yeah.
I think one thing we've learned about like the 2020 dip and what's happening now is like how interest rates play an effect in how the economy is and the emotions of people. Because when interest rates are low, people become overly optimistic. They just go out and borrow and spend however they want. And then as soon as interest rates go up, people just that's when they realize like the tide goes out, and then they're like, oh shit, I didn't have something saved on the side. And they realize they overextended themselves.
Yeah.
Absolutely. So those 3 levels of complexity of what it takes to beat the S&P 500.
Yeah.
What we're talking about.
Yeah. So I think, the first one is like, it's always Warren Buffett's advice. Like when you're getting into the markets for the first time, it's better to just join the S&P 500. Yeah, in a bull market, you'll see people outperforming the S&P 500, just the random guy down your street, We've seen so many people make millions, multiple millions. And now in this bear market, sadly, they're getting wiped clean. So it is actually very difficult, which is Warren Buffett's point, to outperform and beat the S&P 500 over your whole life. People can get lucky for 10 years. And then there's like kind of like 2 sides. The other side of the argument is, it's impossible to beat the S&P 500. So I think what we're trying to do today is we're just trying to explain what our thoughts are on it. Yeah, it's pretty damn hard to beat the S&P 500, but it is possible. And we're going to talk about how much effort, if you choose to go down the path of beating the S&P 500, you're committing to a really intense journey.
Yeah. Maybe touching on one thing you said there about how people don't believe believe that it's so difficult to beat the S&P 500. I see it a lot in like the crypto space where like people believe that the big fuck off returns like of 20,000 APYs from these lending companies and shit, like they're realistic.
20,000 APY.
And I think they believe that like that's a sign of strength, like that's a good thing in the market. And stuff like that. Like how on earth can there be such different like parallels of like beating the S&P is impossible. Like you can only get 2%. And also there's people in the world who believe that 20,000 APYs are like not just possible, realistic and healthy. Like how can we have such different kind of ideas?
Because like the standard returns of S&P is like 10% over like a long window, like let's say like 50-year window, it is 10%. And then you have like these crypto projects that, again, like DeFi and stuff, 20,000 APY is 20,000% a year. That is ridiculous. How is that even real? And then people fall for that.
Yeah. I think it's like in psychology as well, when you anchor them to such a huge ass number and you just keep repeating that a million times, then they start to believe it. And then it's just like, now it's 10% compared to 20,000. And now they just think the 10% is so silly. But, you know, it doesn't make any sense.
I've also noticed that personally, like, because the four of us, we really, like, when we started our personal finance journey and investing and stuff, we were really heavily invested in crypto. And we would see wild returns on crypto. And then we move into stocks because we understand the value of stocks. They actually provide real world value versus crypto, which really doesn't. It's more speculative. If we make 30% on stocks, we compare that to crypto, which makes like 400% a year, which is like 30% so small, but we don't realize we're 3xing the market average.
Yeah. That's right.
It's ridiculous.
Our perception of what is normal returns is skewed. It's fucked.
But when you say 400% in crypto, it's like, at the peak, your net worth might be up 400%, but then no one sells at the peak.
Yeah.
By the time you sell, and what you realize with crypto,
You lose 90%.
because it is backed by, most of them are backed by absolutely nothing, or there's barely any value there. That means it's like kind of like a game of hot potato. It's like you're just chucking the thing
Or
around.
would you say yams?
Hot yams.
So with crypto, you gotta like, it's our advice. Like if you actually want to play the game of crypto, you can focus on the long term and all of that stuff. But if you look at most coins, especially if you're not looking at the big major coins like Bitcoin and Ethereum and all of that, they always die. Like it's very rare that they can last 2 cycles. So that means you will have to time the market. You have to know when to buy, and even harder is know when to sell. Like you actually have to get rid of it. And then when you do that, you got tax you got to think about as well. So it's actually hard to beat the S&P 500 because that's after tax, because you don't need to sell the S&P 500. You can just keep on holding and holding and holding. And with crypto, you got to sell quickly, which means it's in most countries short-term capital gains. You get taxed at a double rate than if you held it for, more than a year.
Yeah.
And if you don't sell, you don't pay tax with the S&P 500. So you got to think about the after tax.
A lot of people, they ask me, sorry to cut you off, Jay, but a lot of people ask me, like, what does it mean when you don't pay tax on the S&P 500? How do you enjoy your wealth?
Eventually, you will have to sell to live off of the money.
Yeah.
There is another level where you don't have to sell.
Yeah.
Maybe we'll talk about both. But one way, which most people do it, is you just keep on investing in the S&P 500 or investments in general. Then eventually that accumulates to so big, and due to the compound effect, it starts to, be like a snowball falling off a cliff. And it gets so big, and then, before you know it, you got $1 million. You make 10% or 20% of that. It means you make 100 or 200K. Because you're making that from an asset, it actually gets taxed less than an income. So then if you sell 100 grand off, you had $1 million, you made 100 grand, you sell off 100 grand of your profit, not touching your principal. It's like you have a full-time income and you keep more of it. That's one way. But then the other way is do the equity line of credit, the ELOC. And these are what the guys like. Just type in like, how does Jeff Bezos pay no tax? Or how does Elon Musk pay no tax? And there's good videos that pop up. Maybe we should even link it into the
we'll
chat
put it
for
in the
people.
show notes,
Yeah, but what you can practically do is you can say, just like when you buy a house, you put a down deposit on the house and you get a loan. You put in 20% or whatever it happens to be. You borrow the rest, right? And it's backed by the asset of the house. Where what you can do is you can do the same thing with your stocks. Like Elon Musk, he would have, $100 billion, $200 billion of assets, whatever it happens to be, depending on the stock price. He can go to the bank and say, "These are all my assets." Yeah, it's more volatile than a house, but then he can take out a loan of like 1%, 2% of his net worth. In his case, that's $1 billion, $2 billion, could be even more. Takes a loan out for an interest rate of like 1 or 2% because
he's a high net worth individual.
You're a high net worth individual, which means you get a lower interest rate. People always say, "Oh, but that's just the rich helping out the rich." No, but it's because a bank needs to get their money back. If you're rich, that means you're trustworthy to pay us back. Poor people, which are getting charged on credit cards, because you're the riskiest investment.
Yeah.
you're extremely risky. You're extremely untrustworthy. That's the truth.
Yeah.
So that's why everybody gets a different deal, depending on how risky you are. And then if he's taking out 1%, and then he needs to pay like 3% on that as interest, but then when his stock goes up 20%, you know, that pays off all of the loan. And not only does he not have to pay off the loan, because his loan to value ratio has decreased, the bank will literally go to him, hey, Elon, you're actually allowed to borrow even more money now. Because you as a ratio, you're not taking out much.
This guy got himself into, not a pickle, he took like an ELOC out on a few $100 million, but he took out a significant amount when they had the 30% drop. He actually decided to sell everything because he didn't want to have the stress of if it went down an extra 10, 20%, he might be in trouble.
Yeah.
So it was like, I feel like it's interesting. Some people might get themselves even into...
Yeah.
They may have taken out too much.
I think that's a lesson on understanding what is the actual potential volatility of your assets you're holding. People think like a house, it can't go down. That was like, if you asked them last year, he'll say a house can't dip.
Can only go up.
Can only go up.
Yeah.
It can dip. Look at 2008 financial crisis. Obviously, that's, you know, an outlier. They dip hard. They can dip hard. I remember with Bitcoin. When Bitcoin was at 70,000 just before, everyone's like, no, those big corrections of 80%, they're done. It's impossible now.
It's always this time it's different.
Yeah, this time is different. That's the worst thing you can actually, you know, you should never ever say that.
Yeah.
And everyone's like, oh, Bitcoin will only dip 20%. I'm like, dude, look at Netflix in the last 5 years. Like, not even before this big recent dip. Even stocks, they dip by 40, 50, 60% frequently. So how is a cryptocurrency like Bitcoin not going to dip that much?
One thing that you were saying, well, it was like when people invest in individual stocks or cryptos, they don't consider, one thing is taxes, but another thing they don't consider is the fees as well. When you're buying individual stocks and cryptos, you're going to have to pay a lot of fees on that. Whereas you can actually, with the S&P 500, you can get exposure to all the stocks with a really low fee as well.
Yeah, the thing that blew me away, like when I first learned more about investing in like index funds, was, let's say like the S&P 500, you got a bucket of 500 companies.
Yeah.
If you could, like, because we have so much access to how we can invest now with like different kinds of online brokers and stuff, low fee brokers, you just put in $100. That $100 gets split 500 different ways. And it's like the fee is so small. It's like 0.01% fee. And you're already invested in 500 companies.
Yeah.
I think that blew me away. It's
Yeah.
like that I feel like everyone has to have some sort of exposure to that.
Yeah. And it's like time. Like, you don't have to spend time to find individual stocks or cryptos.
Yeah.
You can just invest into the S&P 500 and it's trusted.
Yeah.
You know your money's going to go up long term.
Yeah.
So you just can keep dollar cost averaging into that.
Yeah, that's a big thing. Like, you got to think, like, that's a passive investment, the S&P 500. If you're trying to beat it, it's an active. So you better be getting paid for your time. You better be able to beat it.
Yeah.
But like what we say is, like, at the beginning, if you're getting into investing, just like Warren Buffett says, literally his advice, like, you should only invest in the S&P 500 for even like your first 3 years of your career. Like, there will be stages within your first 3 years where you will learn, you know, like when you're talking about Seth Godin's The Dip, your confidence will go up just because you've learned and read a few articles, watched a few YouTube videos, read 10, 20, 30, 40 books.
Yeah.
Right? And that can trick you, like, because your knowledge is going up. You think you don't know what you know and you don't know what you don't know. And then you think, oh, I've been doing this for 3 years. I'm sure I can beat the S&P 500. And then something happens and you're like, oh shit, that was a risk I did not have the ability to see. And now I'm back under performing the S&P 500. Like, the more you learn, then you realize, oh shit, there's even more I need to learn. And then it actually gets so overwhelming that, you know, like, even to actually understand how to join the S&P 500, you may need to dedicate a full 1 year intensely.
Yeah.
Because everybody understands, oh yeah, I trust the S&P 500. Yeah, I understand how index funds work. Yeah, I understand all of that. I know how to invest and make money long term.
How do you do it?
Yeah. And then it starts dipping.
Yeah.
And then you see their skin in the game, their actual dollars leaving their bank account. You were buying so hard at the top. And you're supposed to increase your size as it goes down.
Yeah.
But how come no money's going in? And you're supposed to sacrifice in your personal life, cut back on bills, get more in at the bottom.
Yeah.
And no one does that.
I think, like the last 12 years has been probably like the best time for like investing.
Mm.
And a lot of people, they did get like what you're saying. Like if someone has spent 3 years learning and they just invested in the S&P 500, even then they can still get fooled.
Yeah.
Because you had 12 years of prosperity
Yeah.
and
That's
really
right.
good, like a really good economy. So then you may have done your due diligence, but then you still aren't aware of the downsides because you haven't experienced the downsides.
Would you guys say that that's like the biggest lesson we've been able to learn from crypto?
100%.
Being in the crypto markets early. It's like obviously we went through. Well, how many bear markets have you been through, Dill?
Crypto 2014, crypto 2017, crypto now,
Mm-hmm.
and then stock market now.
Yeah.
So it's a few.
What was 2014 crypto bear market like? Because a lot of people weren't in crypto at that time.
That was the most ruthless one. The dip was so big, and I remember the price was. So I started investing in Bitcoin when I started looking at Bitcoin when the price was about $400 roughly in like July 2013.
Australian dollars or?
I think US roughly around that price. Can't remember exactly.
God damn,
But then
bro.
I spent 6
You're a
months.
prophet.
Huh?
You're a prophet.
No, I
Bitcoin
spent
prophet.
6 months dedicated to just learning Bitcoin and economics and like what is actually happening with Bitcoin. It took me so long, especially back then. It was very difficult because there was barely any YouTube videos about it yet. You know, you only had like this little white paper and people explaining it.
How did you first get onto Bitcoin?
That was from Joe Rogan. Andreas Antonopoulos went on Joe Rogan.
This guy.
Because at that stage as well, I'd watched every single Joe Rogan podcast episode from day one. I went back and watched them all, and then I can't remember what episode Andreas was on. And it started to make sense. And I just thought, it sounds like a good idea. Market cap's like only, I think it was between $1 and $3 billion. I'm just thinking that's an extremely small financial asset. If the whole entire market cap is $1 to $3 billion, someone like Bill Gates can, put in $1 billion. What does that do to the price?
But the fact that you had the knowledge to even know that.
But it was 6 months of really hard dedication before I invested a single dollar.
Yeah.
Then by the time I invested, the price was like $800, $900 in like November 2013. It went up straight to 1,200. Thought I was a bloody genius. And then you start the bear market. I'm dollar cost averaging. I'd learned everything about dollar cost averaging, and I stuck to it properly, putting in $500 every single week. And from like 1 year, it went from 1,200 slowly down to like $300.
You're putting 500 a week.
500 a week just into
Holy
Bitcoin.
Shit, man.
At one stage, I was getting like 2 Bitcoins, like from a paycheck every week. And then, but this is what happened. At $300, my average buy price, so the price of Bitcoin is now at $300. My average buy price is still like $600. Obviously, in hindsight, that seems like it's so smart. You're down 50%.
Yeah.
Then I remember there was a flash crash where Bitcoin went from 300 and it wicked to some websites to $100 in a day. So it crashed like the COVID crash from 300 to 100 in 1 day.
Wow, you must have been clenching hard.
Bro, what's that as a percentage? 75% or something?
Yeah.
If your average is $600 buy price,
Yeah.
and then it went to $100, $500
Yeah.
loss.
It was
Off of, from 300,
It was crazy. And then I didn't have the emotions then. I actually sold off, I think, 25% of my thing because I couldn't handle. That was just
Yeah, I'll be a fucking oath.
because I probably, I'm guessing the numbers would be roughly, I invested about $30,000 by that stage, working my ass off. And then all I had to show for it was like literally $5,000 or something. It was like under 10 grand.
That's pain, man. That's a long
pain,
day.
bro.
So then
long day.
I sold off. I don't even know why. Like, I didn't have the experience. I sold off 25% because I'm like, what if this thing goes to zero?
But at the time, it could have.
Yeah, he could have.
Yeah, that is something that we don't, people don't talk about that much anymore.
Yeah.
It's like, it was we had like 3 different cold storage wallets. We had 5 or 6 different exchanges.
Yeah.
We were buying on. Like, there was, the risk of a hack was, like, the probabilities were so high. You've been hacked and lost thousands of dollars on a few occasions, many occasions. Like, Bitcoin was at a point where it literally could have gone to zero when we first started this.
Yeah.
So to have that in our kind of like back pocket to now be able to look at the markets,
Yeah.
it's like, it's very, very valuable.
Yeah.
What drew you to like dedicating 6 months worth of study to this Bitcoin? Because like
Oh,
you look at a lot of people and they, you know, they just put their money in and
yeah, I
they
think
kind of just play the markets. But what made you want to like really dedicate?
I think the culture is completely different now because of that fake success that we're talking about. You know, on TikTok and Twitter, everybody, you hear all these get rich, you know, people, I made $3 million or whatever it happens to be. And
In
all
2
it
months.
is, yeah, it's just survivorship bias. For every person that made that many millions, there's 1,000 people that lost everything.
Yep.
You know, it's 1 to 1,000 ratio. So we didn't have that type of culture back then. And everybody would tell you investing is extremely risky, which it is when you don't know what you're doing. So I'm just like, hey, I'm going to accept reality for what it is. Investing is definitely extremely risky if you don't know what you're doing. So I'm going to dedicate myself for at least 6 months just to Bitcoin before I put in a single dollar. And then, you know, like what was our mindset with Bitcoin? You know, I personally in investing and all of that was 20 to 30 hours every single week, you know, minimum while working 70 hours a week at Nando's. So it's 100 hours, you know, and it's just constantly upgrading and getting smarter every single week, where most people, if you ask them how many, like even Gary Vee's advice, where he's just like, oh, to learn all the basics about NFTs is going to take you 25 hours.
Dude, that's a joke, man.
It's not that many hours. That's 1 week. That's a great sale, you know? Imagine I think what we're getting at with this S&P 500, like you can join the S&P 500, but to truly understand how it works, you'll think it's basic with your first month of study. Then if you really dedicate yourself, you'll realize there's actually more complexity to this thing.
Yeah.
Then the next level is, well, the last level is you choose to call this level 3. So we spoke about level 1, then there's level 3 where you choose to outperform it. To actually outperform the S&P 500, the average person is like, it takes 7 years of dedicating your life to one thing. It's like literally going to university and getting a master's degree.
Just to like outline it to be clear, like it's to become profitable, not to become rich, not to become wealthy. To be able to do the thing well, it takes 7 years.
Yeah.
Not to be successful, like in money terms, but
Just
to
to,
be
like,
able
outperform.
to, to be able to actually sit at the table and compete.
Yeah.
She takes 7 years.
And then you have to understand that you're getting yourself into something where it attracts the world's smartest minds. The competition is so high and it will only get harder from here. So like when we're talking about our investing strategy, we're constantly talking about this shit's going to fail soon. This, you know, these different parts of our system, they're going to be obsolete eventually. So like it's very, very difficult. So for me personally, my journey was like, what was it, from like age 19 to around 23, 4 years, about 30 hours a week of study, just learning this stuff. Then I was lucky enough to leave my job. Then 3 years after that was about 40 to 50 hours of learning. Total hours of work went down because I wasn't working 100 hours anymore. But to this cause of understanding how the markets work, that amount of time dedicated to that thing went up.
Yeah.
You know, and that brings us to where I am and we are today. And it's already been 10 years. And then there's still things to this day that I learn. I'm just like, oh, wow, that's, you know, you got to be careful because, you know, if I make a mistake or whatever, like even after 10 years, you can get hit really hard.
Yeah.
Like it's so important to know what you know and what you don't know.
Yeah.
Makes me think about like the way the crypto markets operate at the moment and the people that are in crypto. When they look, when you've been doing this for 5 years and you make 3 mil, these boys over here know you're going to lose that.
Yeah. Yeah.
It's so small what you're doing over here, and like you can really, I guess, like confuse the reality of what you're doing.
Yeah.
When you're in that thing. There's a podcast we listen to called The Compound, and they're absolutely baffled how crypto investors cannot be happy with 10%.
Yeah.
They're just confused. They're like, this doesn't make sense. You can't relate it back to the years where the entire market went negative.
Oh, yeah.
See,
You don't
there's
have
there's a
enough
really
data.
good quote by Naval on just like the psychology of how people behave when it comes to money. And it's like, you want people to do well, but you don't want them to do better than you.
Yeah.
And then that's like the whole crypto space at the moment. It's like, yeah, you've got like 100% returns, but I got 150. You know?
Yeah. And if you just keep comparing like that, eventually you take on more risk. And as you increase your risk, eventually you increase your odds of losing everything. You increase your probabilities of getting wiped out.
And we've seen it, man.
We've seen it so many times.
So many times.
Yeah.
We're in a bear market at the moment. And like people believe like in a bear market, it's like, add on more leverage, buy the dip as hard as possible. But the actual thing you're trying to do is survive.
Yeah.
Like you're trying to survive the fucking bear market because the game is to stay in the market for as long as possible.
Yeah.
Be around for as long as possible. Don't try and make your money in a year and then disappear.
Yeah.
Shit doesn't happen. It doesn't exist.
So many boys buying the dip on like Shiba Inu and all of these coins, putting their net worth in like their whole entire paycheck every week.
Yeah.
My Twitter's flooded with that, by the way.
You're supposed to survive, you know? These guys are swinging for the fences still.
Yeah. Probability of Shiba Inu doing what it did last year is fucking zero. She's not zero, but it's much lower than it is higher.
Yeah.
It's less than 1%.
Wow. it's very low, you know? So
Close
like
to zero.
when you're putting all this money in, it's a lot of young people doing it.
Yeah.
Like that's a time, especially when you're young, we talk about it's actually the most important for you to make sure that the money you're investing works and that you are profitable and you're not losing it. So it's actually better to be a little bit safer. You know, something has a higher probability of working. Nothing's 100%, obviously.
That's why we love the S&P, because like it's got that proven track record and you're buying quality stuff, like stuff that literally we use every day. Companies that make these products.
And when you're young as well, a lot of people like just really like gambling. For some reason, people just love gambling. Like even if they know that what they're doing is wrong, like they just love it. They love speculating. So I reckon our advice for that would be at least have a big portion, 98% of your portfolio in something safe like the S&P 500, and then risk like the little 1% or 2%.
Just treat it like fun.
Yeah.
Absolutely.
We all have that streak in us, that degenerate gambler.
Yeah.
You just got to like control that little voice inside you.
And that's the shit. I think it's like, it's made okay by the socials because you see, what are those stupid rocket bloody crypto games? You guys seen them?
Oh my God. Rubet.
Yeah, they put like $100 in and then they just try and see it get 100x multiple or something on it.
Yeah.
Man, what the fuck? Does that sound legit? Think about it. What the fuck?
No, it's actually a problem. Like people actually have crypto investing problems. Like they need to go to therapy. It's a big issue, man. It's a gambling problem.
Yeah.
Maybe one more point before we go into like level 2 of complexity. Like as Hardcore Headstart, like one of our main things is not just investing, but also to acquire great businesses because we position ourselves as to be like Berkshire Hathaway, acquirers of great businesses. And one of our criteria is if we cannot outperform the S&P 500, why are we doing it?
Yeah, there's no point.
And I feel like a lot of people should have that kind of filter. And if they're going to do business, can you beat 10%?
Yeah.
If you can't beat it, join it.
Yeah.
Absolutely.
I think the other thing as well is like, we've been quite negative to say it's going to be difficult because that's the truth. It will be difficult to beat the S&P 500. You will have to dedicate yourself. But I like to use the analogy like, imagine you're 3 or 4 years old and you're going to go swim for the first time and you have an instructor that's going to teach you how to swim. Do you want that instructor to just chuck you in the ocean, you know, and you learn for yourself and you potentially drown? You know, or would you like them to tell you the truth? Hey, that's an ocean. Don't go in that ocean. Go in this little shallow pool where you can't drown.
Absolutely.
You know, so that's what I feel like joining the S&P 500 is the shallow pool where you can't drown. Trying to trade and do your own stuff, your own stock picking from day one, you're jumping straight into the ocean. There's a lot of sharks. She's deep.
That's a really good.
You know?
This is not something we actually just say as well. Something we practice in our business because we have a trading course. Like we turn away more people than we accept.
Yeah.
You're just not. It's not right for everyone.
Yeah.
But something we have a way. So what? Number 1, level of complexity.
Join the S&P 500.
Number 3.
Just try and do it yourself and try and outperform the S&P 500.
And number 2 is
You got to identify someone who you think they can beat the S&P 500. So that's level 2 in the middle. This is actually hard as well because you need to have the knowledge to be able to see that someone is actually smart.
Yeah.
Because when you have no knowledge, and just call yourself level 1 out of level 100 in terms of investing knowledge, someone that's level 3 seems 3 times smarter than you, but actually you need to be level 15 to be able to beat the S&P 500.
Mm-hmm.
So just because someone is smarter than you, more intelligent, and they may be able to talk their ass off, doesn't mean they actually can beat the S&P 500.
So let's say you're looking for someone to invest in. Now, we're the ones who do the investing, but let's say you're looking for someone to invest. What are the things that you're looking for?
First of all, this person's character. Like, are they actually a trustworthy person? Every time they've said something out of their mouth, do they actually back it up? Because it's very easy. Like, a lot of the people that are managing money, they're literally just managing money for themselves because they know that they can rake in the management fees. So they're actually salesmen. Like, they know if they can get $100 million of assets under management and they charge a 2% fee every single year, then they're making $2 million no matter what happens. And then if they do get lucky and the market does go up, and most people, they can't beat the S&P 500, then a lot of the hedge funds and guys like this, they take 20% of the profit from you too. So imagine the amount of money that can be made from these people. And sometimes these people, they accidentally fool themselves. Your ego gets in the way and you fool yourself that you're actually smarter than you actually are. And you start to believe your own lies. But yeah, that's one thing. Like, look at their actual reputation. Do you trust these people? And then you got to have what is their actual ideas? Do their ideas make sense? And then also, do you agree with their ideas? Do you understand their ideas? Only invest in what you understand.
So that means you'd have to be you got to be proper smart to be able to understand what they're talking about and to decipher whether they're talking shit or not.
Yeah. I don't know.
I think Warren Buffett's done a great job over the last 70 years of him just speaking out, because he's gotten that reputation of just being super trustworthy and transparent, especially at his Berkshire shareholder meetings. He says the same thing over and over again. It's like, if you don't want to invest with me, invest in the S&P 500.
Yeah.
So you need to be smart enough to actually see behind the picture, behind the veil, behind the picture.
Yeah.
So someone's saying, this is the good shit. You need to be able to look and see, is it actually the good shit?
Yeah. And
what does it take to get to that?
I would say, yeah. So with the S&P 500 level 1, it will take 1 to 3 years to understand truly how it works.
Yeah.
If you really dedicate yourself, less than a year. The middle one, it's probably 3 years. Yeah, about 3 years, I would say. Unless you really trust someone, it's a friend or family, it takes a while. Someone has a great reputation like Warren Buffett. So I say 3-ish years. But yeah, definitely to beat the S&P 500 and do it yourself, I'd say average is 7 years to become profitable, if not 10 plus. Another thing that we haven't really spoken about yet is the benefit of the S&P 500 is it has no scalability issues. Meaning, you can put in $5 billion of capital. The S&P 500 can handle that investment, right? So you can put in huge amounts of money. So S&P 500, not only is it 10% returns, but it is scalable. So what Warren Buffett says as well is, if he was starting again from scratch, what will his returns be? And if he was only managing millions, it would be 50% every single year, compound rate. And that's actually what he got. His early heydays, because he was managing less money, he could actually get, 50%, 50%, 50%. And that's true as well. So when you're managing small money, there is ways to really smash the S&P 500, but to also get to that a bit, to know how to do that, it's very hard.
Yeah.
And then eventually you'll hit scalability issues, you can get $1 million really quick, then you get to 5 million, it starts to get harder. Now you need to start building out a management team.
I had a question that is maybe answered by that. How do those the big institutions that manage billions and billions of dollars, good old Ray Dalio and stuff.
Yeah,
he makes this year he's doing quite well, but previously he makes in the single percents a year.
Yeah,
is that the lack of scalability? That's one of the main factors.
I'm not sure. Don't take everything I say for being a gospel, but I'm pretty sure with Ray Dalio, I haven't done that much research, but I'm pretty sure his whole pitch is like he will perform decently no matter the market environment.
Okay.
So he's never trying to swing for the fence. If the market turns pretty bad, he's supposed to lose the least amount. I'm pretty sure that's what he's trying to do. So, you know, if the S&P 500 in the bear market goes down 40%, he should lose 20. But if the S&P 500 is up 20%, he should only make 10.
Okay. So people who would have like large amounts of capital.
Yeah.
And they're just trying to almost
Yeah,
like get that ELOC, that equity line of credit, and have no risk
diversify. Yeah, I think that this is actually relates to complexity number 2. When you're investing in other people, you actually want to diversify your investment in other people and other strategies, so you become extremely safe. So one might be, all right, you look at someone like Cathie Wood, who's investing in high growth companies that are early stage, but they're like already public. So that means they're public, they've been around for 10 years already, but they're still small. A 10-year-old company is still pretty small. So you might put in 5% into her, right? Because it's still high risk. 5% of your net worth, not too much. Then you might see a VC person, a few VC people that like to invest in Uber when they're private and all of that. You might invest in 5 type of those people and put 1% to all of those.
Mm-hmm.
Then you see someone like Warren Buffett who does stuff that's extremely safe. Because his stuff is extremely safe, or Ray Dalio, you can put in a lot of money. You know, put in heaps. Like, why does Warren Buffett have his entire net worth in his own portfolio? Because he knows it's safe. And then you might have a hedge fund, which is literally a hedge fund, which means it's hedged, which means there is no actual market direction. They should make money no matter up or down. So it's hedged at all times. So when the market does go down, then that thing should actually go up. So it hedges out your actual net worth. Because if everything else is going down because it's long, then that thing that's hedged out and has short positions on, which makes money when the market goes down, then, you know, it makes you feel better. Mm-hmm. So you have to think, like, what do you actually want? Mm-hmm. Are you okay with big volatility? Mm-hmm. If you are, then you can do riskier things. So your money go up and down 70% every now and then. If that's what you want. But some people, they hate seeing their money go down 10%. So how do you construct a portfolio for your own psychology? So you might put more real estate in there with less leverage. You might even buy real estate pure in cash. You might get some S&P 500 in there. You might get some hedge funds. You might find some algo traders that are market makers, meaning they're trading the market back and forth each second. Quants, those guys, they don't, they don't care if the market's going up or down or sideways. They have
computers, algorithms running for them.
Yeah. Insert the Big Short. Look at him! Look at his face!
That's my quant.
Your what?
My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face.
Look at that quant, guys.
Oh yeah, he does go deep.
That's interesting.
I think the best way to beat the S&P 500 if you're beginning is, you could do a business, but like actually have the knowledge and skills that you have an edge in that one field. Like as an example, you could have worked in one sort of sector, it's still small, but you've been in there for 10 years and you're just like, dude, I hate how my company's doing this stuff. They could change this, this, and this, and this. And then you're like, oh, I'm just going to copy this exact company and change those things that I was speaking about.
Yeah.
And then get the managerial experience and all that other kind of stuff to be able to couple that with the advantage and the skill.
Yeah.
So that applies to like the first level in a way, because like once you learn how the S&P 500 works exactly, you can look at it and be like, damn, I don't like how they're doing this.
Yeah.
So now I can move on to the next level, which is identify someone who can beat it.
Yeah.
Or even change it yourself.
Yeah. But you can open up your own business if you've got 10, a certain amount of experience and you're confident in yourself. You can open up, you can easily outperform the S&P 500. You can make 100%, 200, 300, 400%. But if you keep compounding at 400%, you will eventually hit a point where you have $10 million, $20 million, and now it's really hard to compound at 400%. You'll start skewing down to the S&P 500.
When you're doing that, you may want to diversify as well from your business as well.
Yeah.
In case if your business has some sort of lapse like COVID, for example, some of the businesses that may have been able to survive COVID better than others were the ones that had liquidity elsewhere,
Yeah.
like in the stock market, even though it took a decent hit.
Yeah. It's capitalism. Everyone is actually out there to compete away your idea.
Mm.
You know, so eventually everybody says, oh, my company will never die, my business will never die. But most businesses, they actually do die eventually. So how do you hedge against that? Oh, Amazon's coming to kill all these small little businesses. Invest a little bit in Amazon. You know, hedge yourself, protect yourself.
Yeah,
absolutely. Absolutely. I mean, just invest in Amazon in general. The best shit. So.
Amazon itself is like an S&P 500.
Yeah.
It's got so many companies underneath it.
That's a good one. What do you guys reckon are the characteristics or attributes that a person needs to have at these different levels of complexity? One that springs to mind for me for like level 3 is that continued pursuit of knowledge, like the curiosity. Like you have to continue to try and find the new way and adapt and innovate upon your own strategy all the time. What do you guys think for the other one?
You guys have anything?
Well, I think if you're going to do it yourself, or if you're going to try to find someone who can beat the S&P 500, like that naturally means that you're interested in investing. So if you're not interested in investing, but you still want to grow your money, then just stick to joining the S&P 500. Like do what you want to do in your life. But like, don't force yourself to go down the investing path. Like put in so many hours. We put in so many hours a week, but we enjoy it. This is literally what we love to do. Why we quit our jobs? Because we love this stuff.
Yeah, I think something that I saw, like everybody's interested only when the price goes up, and they fool themselves. Oh, I love investing now. And then you send them like Warren Buffett 3-hour video, and there's the most boring thing. I can't watch it. Like, dude, that's literally a filter. That means you're not gonna like it. You're gonna have to watch a lot more than 3 hours.
Another thing is, who's Warren Buffett?
But it's like, imagine us and a ballet expert's like, oh, go watch this ballet performance. I'm like,
Exactly.
I can't be bothered, man.
Yeah.
That means we're gonna be shit ballet dancers.
Yeah.
You know, we don't have what it takes, but other people love it.
Like, for example, we love The Big Short, the movie. For us, it's like, it's the best. It's one of the best movies, but people find it boring.
Yeah. Everyone else finds it boring.
If you find it boring, then it just means that you might not be interested.
I think notice how we're saying like, if you don't love it, doesn't mean you don't invest.
Yeah.
It's something you have to do. Just, you'd have to do it differently.
Yeah.
I feel like for all levels, maybe if you're joining the S&P a bit less, but for all levels, it's really good to keep up with the current market news. Like whether it's watching like, I don't know, like we watch CNBC or we watch different types of podcasts like the All In podcast and the Compound. Just keeping up with the current market news is just really important.
Yeah. Do you have any points on that, Dill?
When Doc was saying like, what do people need to have to, what characteristics they need to have to beat the S&P 500? I think you need to think extremely long term. You have to have a good understanding of what is actually reality, and that person needs to always ask themselves, how am I actually wrong? If you constantly come across as a more negative, it's actually more positive for you long term. Like typical Charlie Munger, he says no to everything. He always finds a flaw in the investment. That's his job. But everyone else, like one of the things that we do to teach people, like everybody, when they start learning, their confidence is rising. Like we're talking about Seth Godin. Then they come with some investment. They're so hyped up and they really want to help. They have great intentions. They really want to make everybody money, share everything with all the other guys at Hardcore Headstart. And then you ask them, what is one negative about it? Oh man, it's perfect. There is no perfect investment. So if you can't find one negative thing about your investment, it's a red flag, because there's going to be so many. And it's a red flag to show you, sadly, you need to do more, put more effort in to get more knowledge, and then eventually be able to see those things that are wrong with
also, in your guys' opinion as well, what's long term? Like we get a lot of different ideas of what long term is. In crypto markets is different. In stock market is different.
Yeah, I think to really want to be able to beat the S&P 500, you got to be thinking in 3 decades, I reckon, 4 decades.
The thing as well is like the longer time you look, the better your odds are. Like the higher chance you're going to make money.
Yeah.
Like what was that stat? It's like if you invest in the S&P 500 for longer than 10 years, you've like never lost money.
Yeah.
That's right, yeah?
Yeah.
You make money 90% of the time. But as time goes on, that increases to 100%. You're guaranteed to make money over time. because everything grows over time.
We build hardcore completely different to a lot of people, like a lot of businesses.
Yeah.
A lot of the way people think as well. We go super slow. What's that analogy of measure twice, cut once?
Yeah.
We measure 20 times and cut once.
Yeah.
We have a horizon of 150 years.
Yeah.
Yeah.
So it's like, and that's not an exaggeration. It's so long way that we're okay with taking our time.
Yeah. Like we always say, like we're not in the game of getting rich quick. We're in the game of getting rich for sure, like guaranteed.
Yeah.
That's a good one. Yeah.
Yeah.
We don't want to be the richest,
Yeah, it's like
the quickest.
Yeah, the quickest way to get rich is by going slow.
Absolutely. Yeah.
I like that video that we shared in our group chat about Patrick Bet-Davis, who's talking about like the culture of how businesses operate in Japan. Their short term is 20 years.
Yeah.
Minimum 20 years.
Yeah.
Absolutely.
And then you have like companies that are there for hundreds of years because they think so long term.
Absolutely. Well, I mean, people are going to have a disagreement with this, but China, for example, they built a plan of 50 or 75 years?
Yeah.
50 years or something like that?
Long plans, yeah.
They had a lot of problems. They built a plan for 50, 75 years, and I'm sure there's longer ones that exist on how to get themselves from where they are to where they want to be. And like they've taken a large percent of their population from poverty to middle class. And they're going to be like, I think in 2030, they're going to outpace America based on GDP.
Yeah. That is one of the benefits of the Chinese way of doing things.
Yeah.
You got one guy, keep doing it, Imagine if Amazon, they had Jeff Bezos in there for 4 years, you had to get rid of the guy.
Absolutely.
The max they can serve is 8 years. It's quite hard to get things done.
Yeah.
Yeah, absolutely. And that, we're not saying China's the best at everything, because they're not. America's not the best at everything. We're not the best at everything. No one's the best at everything.
Yeah.
People have positives. Things have positives. We want to take a little bit of that.
Take a little bit from each one, yeah.
What else we got, gentlemen?
I think we hit every point, boys.
Feeling it?
Hey,
Feeling this one, boys.
this is a long one, boys.
She's a long one.
She's a long, boys.
All right.
60 minutes, boys.
So our new format of 10-minute podcast turned into a 50-minute. Well,
Yeah.
that's all right. So 3 levels of complexity. First one is join the S&P 500. The second is identify someone who can beat the S&P 500. And third is to try do it yourself. Again, repeating, if you don't understand what the S&P 500 is, go back, listen to our previous podcast, because that'll help you understand this one. And
If you have any questions, shoot us a DM on our Instagrams. It'll be in the show notes below or on the screen as well.
absolutely. Anyone got? We're good?
Hey.
No, we're good.
Go follow the rest of the socials, TikTok, Instagram. We got a lot of shorts coming out. We got a lot of content coming out now. So like, subscribe, leave a comment down below, share it with your friends.
Pack it up.
Pack it up.
Back it up.
Thank you very much for listening.
Alright boys, welcome to episode 29 of Hardcore Headstart. Today I want to talk about the new market update. Everything's looking up, she's all looking down.